Hey, welcome back to Hosting Income channel. This is a channel where you learn about how to make and grow your income. So today we are going to talk about QQQI, another income ETF. This is from the NEOS funds, and it's called the NEOS Nasdaq 100 High Income ETF. The reason why we are covering this fund is this one has a solution for people who are concerned about covered call funds or income funds losing the net asset value, like eroding the net asset value. So this fund actually tries to provide some kind of capital stability, some kind of moderate appreciation of the net asset value or the capital, while also maintaining a consistent yield, which is like balancing both sides of capital and the income part of it. So let us look at what the fund is all about, what kind of strategy they follow, which enables them to differentiate from others, and what are the pros and cons as usual, and also learn about my thoughts and what I think about this fund and other comments. So let's get started. Before we go ahead, I would like to just say that this presentation is only for educational purpose and just to illustrate you know the concepts and not financial advice. So with that, let's move ahead. NEOS Nasdaq 100 High Income ETF. That is the fund, and the ticker symbol is QQQI. So here, the fund strategy you know, is similar to any other covered call strategy. It's basically the fund holds the Nasdaq 100 stocks or the constituents of the Nasdaq index, and they write covered calls to generate the monthly income. So these aspects are pretty similar, just like any other covered call. The third point I would like to emphasize is like they also do something called purchasing index options. They may purchase, like not always, they may purchase index options in order to capture the extra upside. That is usually in case of uptrending markets or rising bull markets. They may try to capture the extra growth, because covered call funds are known to cap the upside. The covered call funds limit the upside to the level of the strike price which is written off. But this fund actually buys a call contract above that, which enables the fund to capture the extra upside beyond the covered call strike price. So that enables the fund to capture the extra upside in case of bull markets or rising markets. I think this we have witnessed in the recent times, probably in the month of July, August this year. Uh, so that's the advantage of this fund. Okay, these are the basic facts and figures about the fund. Ticker is QQQI. Price is about $53. The fund was started January 2024, so we have some history. Like it's about 1.5 years now. So we have some historical data and numbers to look into. And the fund size is pretty large. It's 3.9 billion. I mean, for a covered call fund, I know in this space this is a big size. And expense ratio is 0.68. It's fairly decent expense ratio, not too high, not too low. It's pretty good. And yeah, all the information you can see on neofunds.com. You can visit this website to know about this fund. And you can also look at one of my previous videos about SPYI. It is SPYI, which is about a similar kind of fund which covers the S&P 500 index. So I put the link below in the description section. You can check that out, or you can go to my videos or playlist, and you can find that in the fund, deep dives. One of those videos, you can find that. So let's go ahead and look at what are the other features of the fund and what makes this so different. So if you look at the performance, like that will tell us whether whatever they're claiming, is it true or not. So the first one is like they are saying that the fund is able to stabilize or grow the net asset value. So 1 year ago, if I look at the price, like, so this is only 1 year performance I'm looking at. So if I look back 3 years, 4 years, things may be different. So for the purpose of this video, we are just looking at a limited information. So that's a disclaimer. If you want to know more about the fund, you should always do a thorough research. Of all the angles, we are looking at a few angles to get a quick overview. So 1 year ago, the price was 51.50. Now it is 53.18. So capital appreciation 3.3%. if you invested 1 year ago. So overall, it's a decent capital appreciation for a covered call fund because covered call funds are known to, erode value or erode the NAV while they give high income. So that's a positive factor in this fund. So that's one aspect of it. This is possible because they are able to do the purchase of an additional call option beyond the strike price to capture the extra upside in case of bull markets. So that's the point you need to keep in mind. So with that, let's move to the next area. So this would be dividend yield. Dividend yield is pretty good. It's about 14%, and any double-digit yield is always welcome. Right? Nobody wants to complain about that. So when I looked at the yield for the last 12 months, it comes about $7.33. And given the price of the fund, and if you calculate the yield, it comes to 14.2%. And the good news here, what I see is this is my observation. There are many funds which provide 12 to 14% yield, like there are XYLG and many others. However, this fund is able to also maintain the capital appreciation plus dividend yield. That's commendable. Like there are a few other funds which do similar performance. Not debating that. Of course, you have options, but this is one of the funds which are performing really well. And the good thing about the capital stability is like at some point you don't feel like the value of your holding is coming down. Like even though it's easier to convince that you can always purchase cheaper and bring your average cost down, do dollar cost averaging, or if you buy low, you get a higher yield and all that. I mean, sometimes it's not convincing because when everything is going down for a period of, let's say, 2 months or 3 months, from an investor perspective, you cannot keep pumping in money all the time to reinvest, right? You also have other expenses, other limitations, other resources to take care of. So, given that context, if your original capital or the funds are safe and they are also yielding good amount of dividend, if you need to for whatever emergency or financial need, if you need to take out these funds, you are able to sell them at a decent, profit or a decent value. Not necessarily profit, at least you are able to sell at the par value and take out some funds if it is required for your financial needs. This is my own personal observation because it's not just about investing, but also about your personal goals and personal financial situation. Okay, so overall, I would say this is a great option because you are getting a mix of capital appreciation plus dividend yield. That brings us to total returns, which is about 17.5%, adding up to the two. This is based on the 1 year performance. Like if you invested 1 year ago, you would be seeing this. But today, if you invest, the numbers could be slightly different. And going forward, it's difficult to predict where the price will go or where the dividend will go. But this is a great option for those looking for NAV or capital stability, as I mentioned earlier, and overall returns are pretty strong. The third point, which I want to say, just to give a balanced opinion, is the recent market trends or the market pattern be favoring this fund. However, that is not fully true. It's partly true. There are other covered call funds which are also performing really well in the same environment. So again, the market trend could change and things could change. When things turn bearish or market changes, then you'll have to be prepared for that scenario too. Okay, so usually the 12 to 14% is achievable, yield is achievable. That is what I feel, but it can go below 12 as well. Like if there is a decrease in volatility and it's a complete bear market and options markets are not giving enough premium, can happen. But this is achievable. Like I am talking about 1 year yield, 12 to 14% is achievable, and no major downturn so far. Like so far, we have not seen any major crash or correction or dramatic fall. So the last 2 points are connected. Like since we have not seen that, so it seems that 12 to 14% is achievable. It is subject to future trends. We never know. So be prepared for that. That can happen. So that is the reason why I say that you need to diversify across different strategies, different types of funds, not just one type of covered call fund, because every fund is made for a different market environment or strategy. And so that brings us close to the end of the presentation, but I want to share a few other important points. So stay tuned. The pros and cons. This is one area which you need to, do your own research as well, because there are some points which could be obvious. Some of them will be a little tricky. Okay, let's look at the pros. This is basically suited for high income. So it's high income is a positive, and you're also getting the extra upside from the purchased index call options, in rising markets. So that's an extra upside you're getting, which is giving you the extra edge compared to the traditional covered call funds. And stability of capital is something people are concerned about. And when you have lesser capital erosion, like it helps you to uh, keep holding on to the investment despite market vagaries and market volatility and ups and downs. You're still able to hold on and be focused on your goal. And also the fact that the total returns will be more predictable if you have a capital stability. And the fourth point is about the tax advantages with index options. There are some special contracts in the tax laws in the US, which will give you some tax benefits. So I am not a tax expert, so I will not comment on that. So do your own research and consult with the accountant or tax advisor. So you will get a more details about that. You can go to the website and look at the information. So they have provided information about these advantages. So those are the key advantages of investing in this fund. So while you have these benefits, there are few drawbacks. Some of the drawbacks are pretty obvious. There's no major issue with the fund. Like I don't see any big issue or uh, kind of problem with the fund or anything like that. There's only a few which I want to highlight. Uh, the upside is capped just like in any covered call fund. So that's something you need to keep in mind. It is not equal to investing in an index ETF, and the extra upside you're getting uh, could be a little extra. Not like you're going to not going to beat the index ETFs. Rarely, in some cases, you might end up beating the IVVs or SPYs of the world, but generally, you're not going to outperform those funds. So as long as you are getting sufficient returns and it's meeting your objectives, I think this is a good fund to consider. But if you are a growth-oriented investor and you want to get the same returns as SPY or IVV, then you can look at index funds. The second point is also again not a major constraint, but it's just another point I want to highlight. There are a lot of high yield funds, yield max funds, round hill funds. These are funds which are able to provide you not only the high yields, but they are also paying you every single week, every Friday or every week you're getting paid, like just like a paycheck. So when that is happening, like you try to compare these funds and you see that, oh, this fund is giving me 14%, that fund is giving me 24%, like that's better. Like just keep in mind that uh, every fund has its own pros and cons. Even the higher yielding fund has certain issues or certain drawbacks. So what can you do? Do you choose this or choose that? See, there's no right or wrong answer to this. It all depends on your goals, your preferences, your investing style, and your risk tolerance level. It's based on all these factors. You can choose, SPY eye as a starting point. Let's say you're a new investor or conservative. You start with SPY eye, this one. Not a recommendation, I'm just giving you as an example. You can start with SPY eye, and later you want to add a bit of more income, high yield income. You are more comfortable with these funds, and you build your experience and you are confident. Then you can move into the high yield area, which is more risky and prone to capital erosion, NAV erosion. That's the point we were mentioning in the pros too. So you will have like kind of a trade-off. Like you cannot get everything in one platter. So you're going to get a bit of trade-off in terms of absorbing the risk of NAV erosion while getting the high yield. So those are the pros and cons. And this fund would be, suitable for, conservative or even moderately conservative people who want to get an exposure to the index and covered calls income, and also have the stability of the capital or the NAV. If you want to look at other options in the same space, uh, okay, just one point I want to mention that the other funds that I am showing here, these are not recommendations. These are not the ranked or by any criteria or anything. These are just my personal observations. So when I compare with SPY, I like these funds too. XYLG from Global X and GPIX from the Goldman Sachs. So these funds are not exactly the same. The covered call strategy is similar in most of these funds. However, each one has a different twist or a different you know twist to the tail basically, where they're able to capture upside in a different fashion, or they're using a little different kind of style. Just like SPY uses the call buying above a certain price to capture additional upside. XYLG uses a different strategy. So what I like about it, XYLG Global X Fund is the fund invests in the S&P stocks. It's a similar, but it writes only 50% of the portfolio. The covered calls are written only on half of the portfolio. So out of the whole portfolio, only one half is being used for the covered call writing. So the other half like can get the full upside or growth potential. That's unlimited. So in that way, what is happening is you're able to capture a covered call income with a limited upside on one side, and on the other side, you're also able to capture the stocks having full upside without any covered call, without any other addition to it, because they just buy and hold the stocks. So basically, you get the full capital appreciation. So full capital appreciation and then limited capital appreciation with regular income. So you're mixing the best of both worlds. So that's what XYLG is trying to do. Uh, so when I said SPYI is bringing in consistent income plus also capital stability, XYLG is also achieving the same thing, but they are using a slightly different strategy by investing only by writing calls on only half of the portfolio and letting the other half move according to the market movements. So that's a beautiful strategy which I like. And GPIX, which is the Goldman Sachs S&P 500 premium income. And again, this is based on the S&P 500, and they have the same stocks, and they write covered calls too. The way they write covered calls is a little different here. So in XYLG, they put a number to it. They said that we will write covered calls on half of the portfolio. Half means exactly like around 50%. Now, Goldman Sachs actually does it in a different way. It is very difficult to explain the internal strategy that the fund managers or analysts are using because it's very dynamic. What they do is like if they feel that the market is going to move uptrending, for example. So what they are going to do is they are going to let the holdings, the investments, appreciate in value and not write too many calls. Or they may write calls which are pretty much out of money, like so that they can capture more upside. So they try to balance it in such a way that in an appreciating market they want to hold the stocks, write less calls, or maybe write calls pretty much out of the money or far. So that way they're able to capture more upside and probably moderate or less income. So that way they're able to balance the income and the appreciation potential. So they don't stick to a number like 50%. It could be 50%, it could be less than that, it could be more. There are times when the market is too volatile, the market is not rising, it's range bound and slightly moving down. So they might write more calls in that environment, which is favorable for covered calls. So this is just an idea which I'm telling you, but it could be a formula or a kind of a model that they are following internally that enables them to achieve that. You can always look at their website, Goldman Sachs website, to understand the fund documents and the strategy. And similarly, if you have time, you can look at the XYLG as well. And I've done a previous video on both of them, like XYLG separately and GPIX also. And in one of the popular videos about GPIX, the reason it got popular is because GPIX was relatively new at that time. Like when GPIX was able to beat some of the bigger funds like JP, JP Morgan Fund, which is also doing covered calls. So that's an interesting video. You might want to check that out. You can go to my playlist and check that. And yeah, so these are my opinions. These are my personal observations. So if you are looking at SPYI, but you want to look at other options, alternatives, you can look at these funds, which are, some alternatives, see which one suits your investing style or your preferences, and then you can, decide accordingly. So I hope you like this video and the presentation. If you like what you're watching, please feel free to, share your comments or feedback. But also, if you want to follow our channel, you can follow it at YouTube and you can subscribe to our channel. And also, if you have any comments, questions, please feel free to share below. And have a great day. Happy investing.